Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me this afternoon, we have Russell Rhoads, Associate Clinical Professor of Finance at Indiana University, and Dan Deming, Managing Partner at KKM Financial. We're here to discuss why investors should be watching volatility futures versus being so focused on the spot to get a better feel for sentiment. And Russell, I think I agree with you on that particular sentiment. I saw a couple charts out there this morning showing that this was the third highest vol pop behind the housing crisis and COVID, and also for some folks calling for emergency rate cuts in between the Fed meeting. That feels a little bit penny-ish to me.
Yeah, it's VIX earlier in the day. I really do question that 65 high print for VIX, but
right.
that's what they're showing. But especially what happens with respect to volatility indexes and the way that they're calculated during periods of higher volatility like we're experiencing right now is the midpoint of the bid ask is being used. And you'll see a lot of market makers widen out their bids and their offers, typically a little bit more to the offer side than the bid side, and that can result in a spike on the VIX chart. Now, without going too deep into the weeds on it, VIX is not a tradable asset. The closest thing that you can do is VIX futures, and the VIX futures, because you can't trade spot VIX futures have more of an outlook component than some sort of fair value component to them. So whenever we have days like today, I make darn sure I have the front month VIX future and right next to VIX on my screen, just to get an idea of what people are thinking, people that are putting money to work with respect to volatility and VIX derivatives. And as long as that August contract kind of remains at a decent discount to spot VIX, even though we're down an awful lot, it doesn't feel like we're going to be overly panicking quite yet. So that's why I suggest you pay attention to that curve.
So, Dan, what do you think this is? One of the reasons that's part of the function of this? Do you think there was some leverage that was building, and now margin calls are going to have to be made?
Well, I think that's part of it, Jill, and particularly when you look at the extreme that Russell pointed out. Now, that extreme print in the VIX was around 7:30 Central Time, which was when the S&P futures were on their low around 51.20. So, as Russell pointed out, I mean, if the market all of a sudden goes into these big selling squalls or hits these air pockets, you'll see market makers widen out their bid-ask spreads, and that has an impact on the VIX cash. And that's why, as Russell pointed out, in times like this, it's better to focus on the futures market and also glean information from what the futures market might be indicating as far as sentiment in the market. And we did see that front month future trade up to 37. So that's the intraday high. And now it's come well off that. So nowhere near the 65. But it's very typical for the VIX futures to trade at a discount once we get to these extremes.
Yeah, Russell, do you think because volatility was trading at such a low level that it feels like it's more of an extreme move going from where it was to where we are now in such a short amount of time? And then from a fundamental perspective, what do you think could potentially be contributing to it? It's, market valuations have been high. We're hearing some conversation around layoffs, geopolitics. It's not as if anything really new is out there.
Right. The funny thing is, Steve Sears, we all bow down to him for coming up with the term fear index with respect to VIX, but it really is more than a fear index. And as you pointed out, you didn't use the word, and I still have not come up with a good version of combining the word surprise and fear together, kind of like frenemies for friends that are enemies. But you do have to have a surprise component to it. And I do feel like we had a bit of a surprise in the markets on Friday. We saw the adjustment in the futures markets that now indicate we're looking at a 50 basis point cut at the next meeting, right after they got a meeting where they said where the door is open to cut, and everybody was pretty content with 25 basis points. So I think the surprise here, even though there was a lot of bad things going on in the world, is that the U.S. economy seems to be slowing a lot more quickly than people were anticipating, and especially within the tech sector, where you see a lot of headlines with respect to a lot of layoffs. So I think the surprise component that really got us going was what we saw Friday morning. And typically when we've had big reactions to the employment number, they do tend to they tend to carry through I think usually till late Monday or kind of midday Tuesdays before it really feels safe. So we'll see if that pattern, that historical pattern holds up as well.
Yeah.
Yeah, and Dad, I want to get your thoughts on this too. I mean, even if we were to get 25 basis points, I don't think that's really necessarily going to move the needle in terms of lending or even with housing. The problem there is supply, and that's a whole other conversation. But you know, for some folks calling perhaps for an intra-meeting rate cut, I feel like if you were to get something like that, that's the surprise factor, right? I think that would scare me more.
Agreed, Jill.
Yeah.
Yeah, absolutely. I mean, that would be the surprise factor because that could be interpreted, you know, many different ways, and most likely very as a warning sign that things are possibly worse than what the market had remotely priced in. That the Fed feels the need that they'd have to go intra-meeting on a move, particularly when we're really only a little over a month out from that potential 25 to 50 basis point cut. But I will add to what Russell mentioned. I think the other thing that had a significant influence that probably was underappreciated was the Bank of Japan shift as well. I mean, really, that has also unleashed a different dynamic in the market that it was not having to contend with the first 6 months. And that was another cumulative effect, a factor, I think, as to why certainly when we did see the Nikkei down as much as it has been over the weekend, that was a big contributor to today's selling pressure. So that I think, you know, it's a combination of a lot of things and shifting dynamics as far as the central bank activity, as well as the unexpected price movement in the markets. And then we went through some extremes. 5,400 in the S&P was our kind of line in the sand. Once we broke through there, I think you had options traders really shifting their exposure to the market. And that's why I think we did see the VVIX, the measure of implied volatility in the VIX options, hit the highest level today since March of 2020, and that was 192.5. So we did see an explosion in demand for VIX options on this sell-off.
Right. Well, Dr. Rhoads, let's use this as a learning lesson, right? You're the professor here. Why do investors on this side of the pond in the US kind of get freaked out when things happen with the BOJ or with the yen? I mean, we've seen moves in other currencies and other central banks. Why is the US market so tied to what's happening with the Nikkei, the yen, or with the Japanese economy?
Eventually, because a lot of money has flowed into the U.S., we've been a safe haven really since COVID, and I think it's a big contributor to the outperformance of U.S. stocks versus other markets. Typically, when you see some sort of, I always use the phrase volatility event. When you see some sort of volatility event like we're seeing in the Japanese stock market, that's going to, and Dan mentioned, you both mentioned margin calls just a few minutes ago. You got to come up with the cash from somewhere. Yep. And you know, the U.S. stock market's still at higher levels valuation wise than most other stock markets around the world. That's going to be one of the places that some cash gets raised. But also, you know, the global economies are so tied in with each other that, you know, it used to be a wave where one market would open, then the next one would open, et cetera. But now in the 24/7 world, we can see how our markets are reacting to what's going on over there. And that might actually accentuate moves to the downside where people get up in the morning and see just how far, you know, S&P 500 futures are down and Nasdaq futures are down at 6, 7 a.m. U.S. time. So the 24-hour trading may actually exacerbate some of the trends that are picked up in other markets. And since you brought up form, I can't help myself on this one. The only bullish headline I saw so far today was something about China's PMI. If the only bullish news we can get out of China, goodness gracious, are we in trouble?
Well, I mean, Dan, you had noted too that really is the shift in central bank policy that's contributing to this, and it feels as if central banks, global central banks, would somewhat act in concert with each other for the most part. It feels as if, I don't know if disjointed is the right word, but they're not necessarily working their policy in tandem with each other, if that makes sense.
No, it does make sense. It absolutely makes sense. And, you know, the U.S. has been kind of, for the most part, leading that movement over the last several years, really since the COVID situation had a change in the policy and had to, manage that situation as we came out of that with the heavy inflationary pressures. And, for the most part, I'd have to say that the Fed's done a good job in kind of leading the rest of the market. Now we're seeing, as you pointed out, now that the shifting dynamic as far as markets trying to get some equilibrium here, we're seeing inflation coming down. But Japan has always been on, a unique path relative to the rest of the globe. And the fact that they are now shifting their policy to a much tighter stance, with the inflection point that we're seeing in other central banks, and now the idea that maybe the U.S. is slowing more than what was priced in. And we did have extremes. Last time we had the segment, Jill, Russell and I talked about, the dispersion within the markets, and you were seeing extremes within, the big names versus the small caps. And then all of a sudden there's some big snapback. And, watching this market over the last 40 years, and I think Russell can attest to this, we've seen those points where you see like the Russell have these catch-ups. And that's typically, to me, that it signals a little bit of a potential toppy type of pattern, because you're seeing just the elasticity in the market really picking up. It's almost like tremors before something is going to shake loose. And, here we are. We'll see if, if it's going to be something more dramatic. Hopefully not. But at the same time, it does feel like we had the tremors in the middle of July that are now leading to some of this dislocation and some, we're seeing a shift in sentiment, as Russell calls it. I mean, I like to call the VIX the sentiment indicator, but a big shift in sentiment as the markets are now having to adjust to a different type of realized volatility dynamic.
Yeah, Russell, that always makes me nervous too when you see that pattern where the S&P 500 is moving higher and the VIX is creeping up with it. It almost feels like that is an inflection point. The band is stretching a bit there too.
Yeah, and we saw a bit of that. It really held up for about the first 3 or 4 months of this year, and then fell apart. VIX actually made it to lower levels. So the trend had fallen apart a bit before we came upon the current inflection point. Just to piggyback on something that Dan said that kind of popped in my mind, we did see that small cap outperformance over the last couple of weeks, and the headlines were saying things like, well, it's a rotation out of the Magnificent Seven into small caps. Well, the whole Russell 2000 is, I think, I don't know where we are today now, but pretty much the same size as Apple as a complete company. I don't think it was necessarily money coming out of those and going into the small caps as much as new money looking for a place that would be safe during a market sell off like we're having. And maybe the feeling was that because small caps have underperformed so much, there's less downside in that area